Yeah,
All right.
ready when you are, yeah.
Well, then, let's make sure that we try to be respectful of your time. So good morning, everyone. Thank you for joining us, both the folks who are with us in person here at the Baker Institute, as well as people who are joining us online. For those of you who I haven't met, I'm Mark Finley. I'm the Fellow in Energy and Global Oil here in the Center for Energy Studies. I will introduce our guest speakers briefly shortly, but this, just so you all know, this is the latest in our series of energy market updates here at the Baker Institute. And we are, as I mentioned earlier, both in person and online today. So when we started to put this event together, it was pretty obvious what the focus would be. Prospects for prices at the pump, and crude oil behind that, as we head into the summer driving season. Over the past year, prices at the pump have been at the center of our discussions, not only about oil markets, but also the economy, as well as domestic and geopolitics. Last year, we had one of the biggest increases the world has ever seen in both the price of crude oil on an average annual basis and in prices at the pump. Just the increase in prices at the pump last year alone were equivalent to an extra $1,000 of spending on energy for every American family. And prices of crude oil and gasoline extend, in their importance, way beyond what it means for the family pocketbook. They have a direct impact on consumer confidence. They have impacts on the approval ratings of our political leaders, and they weigh very heavily, as we will discuss, in terms of international relations and geopolitical consequences as well. On the back of that, last year, we saw, to manage the political and economic consequences of that, we saw an unprecedented release of strategic stockpiles, both here in the United States and in Europe and other members of the IEA countries. And we saw, the President of the United States visit a country that he had previously vowed to make a pariah, Saudi Arabia. Fruitlessly, it turns out. We've seen significant pressure on supply of both crude oil and refined products from one of the world's largest exporters, Russia. We now have in place an EU embargo on purchases of both crude oil and refined products for Russia. We also see G7 price caps on all of those products. And we've seen a massive reallocation of flows around the world of both crude oil and refined products, and the process of adjustment continues. And just last month, we saw a unilateral Russian announcement of a supply cut, although the actual amount that's been cut and what really drove it remains unclear, and I hope that we'll have a chance to discuss some of that today. And to all of that, we can add our usual list of things that we worry about when we talk about the oil market. Are we going to have a recession? Are we going to have strong demand as China reopens from its zero COVID policy? Is U.S. supply remaining constrained as investors remain focused on demanding financial discipline from the U.S. oil patch? One interesting wrinkle this year is that we're seeing some unusually strong growth in supply out of Latin America, and in particular Guyana and Brazil. And that was all kind of as we were setting the table for thinking about how to put this thing together. And then, as it usually does, the oil market threw a surprise at us. This time in the form of a surprise weekend announcement by Saudi Arabia and a couple of other countries in the so-called OPEC Plus group that they were going to add their own production cuts on top of cuts that the group had previously agreed to institute. Adding Russia's voluntary cut brings the total promise from this surprise round of cuts to almost 2 million barrels a day, about 1.7 million barrels a day. And not surprisingly, prices have jumped. Prices today are around $85 a barrel, and have jumped about $5 just in the last 2 weeks. Prices at the pump have gone up by 25 cents a gallon over the past month. And so here we are again. Markets, politics, geopolitics, all coming together for a product that remains essential unless you drive an electric vehicle. And by the way, even if you drive an EV, you're still dependent on hydrocarbons if you have any plastic in your life, for example, or get products delivered to your home. So where are we heading? What are the key factors to watch? We have a great panel to discuss today. My colleague Jim Krane is the Wallace Wilson Fellow here at the Baker Institute Center for Energy Studies. Claudio Galimberti is the North American Research Director at Rystad Energy. And also joining us online, Francisco Monaldi, recovering from COVID, and thank you for not sharing the love with us, Francisco. Is the fellow here at the Center for Energy Studies and the director of our Latin American Energy Program. So I've asked each of Jim, Claudio, and Francisco to take about 10 minutes to offer opening remarks, and then we'll turn it over to you. For people who are joining us online, you can put questions in the Q&A function, and they will pop them over to me as well. So we can take the questions online as well as from our in-person audience. So without further ado, Jim, thank you.
All right. Well, thanks, Mark. Great to see you all. Thanks for coming out in the rain, and hopefully it'll slow down so you can get out of here. So, as Mark said, I wanted to do a little bit of geopolitical scene setting to kind of kick off. I'd start with a look at this always, intriguing OPEC plus configuration that has been keeping us up at night and keeping us busy. So, first thing I might say is that this is not your daddy's OPEC, right? So it's this is the we're kind of used to this Saudi-led cartel. Over the past couple of decades, being more like a central banker in the oil market, right? Sort of interested in stability, providing these stability services that are actually pretty valuable to us, oil consumers. They wanted to, they had aims for this, keeping oil as our primary transport fuel for as long as possible, right? We might imagine it as, I sometimes when I talk to reporters, as your granddaddy's OPEC, right? It looks a little bit familiar for those of us who remember the 1973 embargo, and at times when OPEC was more willing to engage in geopolitical clashes, right? So back in those days, it was the Arab OPEC members that punished the U.S. for intervening in the 1973 war to help the Israelis. We had an embargo, we had major price hikes, we had a sweeping a bunch of nationalizations that were occurring at that time, led to shortage and led to lots of inflation in consuming countries. And eventually, down the road, some demand destruction and then a supply glut, right, for quite a while. So what we're seeing now, this reprise, if you will, of this political activism within OPEC, or maybe not, a bit more of an activist OPEC. I kind of pin it to two events, right? So first one, the 2015 death of Saudi King Abdullah, who was just a very cautious ruler, very cautious man in general, and you might even say cautious to a fault on some issues. And the second one, and he of course was replaced. King Abdullah was replaced by King Salman and his son Mohammed bin Salman, now the Crown Prince. So much more activist, forceful, forthright leadership. And second event was the 2016 when OPEC broadened out into this OPEC plus configuration that we see today, really with the coming together of the number two, number three oil producers, Saudi Arabia and Russia, long-term adversaries during the Cold War, now kind of seeing common cause. By the way, brought to you by U.S. shale, right? So they were losing control of their ability to manage the market, so they got together. And King Salman and Mohammed bin Salman really took, Saudi strategy in a new direction, oil market strategy and otherwise, which is now being called Saudi first, right? I'm sure those of us in this room have heard this term, and it's really put some distance between us here in the U.S. and our partners in Saudi Arabia. I think there's some exceptions to that, right? I mean, still pretty strong military cooperation. I think under the Trump administration, relations were certainly closer than they are under Biden. Especially under Biden, we saw, relations with the Saudis, especially their oil strategy, taking a kind of a more confrontational tone, really that was at odds with what we were used to here in the U.S. and what Washington had been expecting. Saudi Arabia really became a price hawk, right? They kind of joined the price hawks, and that's kind of a new thing. They were always the kind of the cool heads that prevailed versus the other price hawks in OPEC. At times Iran and Venezuela, countries that, ministers that were clamoring for higher prices. And now we've got this kind of more activist Saudi Arabia within OPEC, and we're seeing it do things like preempting changes in price. So when they see, worrying data, they want to defend high prices. It's sort of a let's act first and ask questions later kind of strategy. So that's why I think, are one of the reasons anyway why we're assembled here today, right? We want to sort of sort out what they are up to in OPEC and this surprise cut that we just saw. So I'm going to argue that the cut we just saw this month is pretty consistent with its behavior, this sort of Saudi first change in behavior that we're seeing out of OPEC. We all remember back in October, oil prices were about $90, right? And the Saudis cut. They pushed a cut through OPEC, the 2 million barrels a day cut that Mark was just mentioning. Of course, there was an uproar. This was 2 weeks before the midterm election here in the U.S. It looked like, MBS was trying to help the Republicans in the election. Some pretty harsh words from President Biden. A lot of folks were pointing out this was helpful for the Russian war aims in the Ukraine, providing it with more revenue. Of course, at the time, Prince Abdulaziz, the Saudi oil minister, said, hey, this is based on market fundamentals, stuff that we're seeing in the data. This is not any kind of a political, agenda that we have against President Biden. And then, of course, this month, another cut with oil at $80, right? So both of these cuts came at times when prevailing market prices were already higher than those that had previously triggered this type of intervention, right? So substantially higher. So I, argue this is kind of a manifestation of this Saudi first strategy that we're seeing. It's the Saudis kind of pushing these cuts within OPEC. There's been some resistance even within OPEC to them. The UAE, for one, has appeared pretty keen to let Washington know that it opposed at least that first cut. Really tried to talk the Saudis down from going so rashly. But if we use this, this theory of, hey, this is consistent behavior over these two cuts, it seems to make some sense, right? If you cut when oil was 90 and you didn't do it to screw over Joe Biden in the midterm elections, you did it because you saw some weakness in the market. Does that mean you do the same thing when oil is at around 80 and there's some talk of weakness in the market? It had tested even 70. A few weeks before that, maybe you do, right? So I think it supports that kind of, hey, this is a technocratic move that we're taking. It's not the revenge against Joe Biden narrative. So, and also, by the way, very conveniently, right? This also supports the notion that Saudi Arabia now needs high prices for some of its domestic public works spending, these giga projects that you've all heard about. They're having a lot of trouble attracting foreign investment on these projects. So MBS is really stuck paying out of pocket for these things that are so tied to his prestige. So what does all this mean for the security of oil supply as we head into driving season here? Well, I think it's fairly obvious there's some increased geopolitical risk in the oil market. Those of us who drive big and inefficient vehicles or planning on taking long road trips or have long commutes, we're going to be more exposed to that risk, right? I think maybe less obvious is that our risk exposure has also increased collectively because of this, Biden administration selling off oil from the Strategic Petroleum Reserve and not promptly refilling it. I think we are less likely this summer to see any kind of a response with the SPR if we see really high prices, because it still hasn't been refilled. It would be irresponsible to keep draining it at this point. I think the SPR release is the fact that Biden had to turn to emergency stocks rather than having the Saudis bring on their spare production capacity. We certainly asked them to do this, and they basically said no many times. This is a factor of this lost U.S. influence within OPEC. Amid this OPEC plus configuration. And I think it may have even been, a motivating factor for the April OPEC cut, right? I mean, I think the Saudis could be sending us a message. It's us, that use this. We're the guys that have the spare capacity that use it to manage the market, not you. This is our job, right? And so to drive that message home, OPEC is making it now more painful for this delayed refilling of the SPR. So I'll leave it there.
Great. Thank you so much, Jim.
Sure, thanks.
Next, we'll move to our online guests. And Claudio, the floor, metaphorically speaking at least, is yours. Thank you.
Mm-hmm. Excellent. Thank you very much. Thank you, Mark. Thank you, Jim, for a great overview of OPEC and the oil markets according to your view. Let me share my screen, and please let me know when you can see it. Is this something you can see right now?
Not yet.
Not yet.
Should come through. I hope it does.
The magicians behind the curtain will get it.
There we go. Now we see it.
We see it.
Perfect. Excellent. So let me just run you through what our latest thinking is in the next 10 minutes regarding the oil markets. Thank you for your introduction. By the way, Mark, indeed, I'm the North American Research Director for Rystad. I've been in the oil industry for many years, most of them in Houston. Since 2004, I worked at Shell and a variety of other companies before Rystad. So let me just take the view from, let me start with demand, because we may argue that the OPEC cut came at a point in time when the market were supposed to be tight. So the question is, why did OPEC decide to make such a huge cut? And I'll show you the numbers that we have. So there are a few hypotheses. I agree with Jim. So it could have been, of course, defending the oil prices at a threshold above 80. It could have been just to go back to Biden administration because of the SPR. Could be many factors, but I think probably we need to consider the demand side of the equation. And if we talk about demand, China this year at least plays a huge role. And I put here a few leading indicators, a couple of leading indicators which are very important. PMI. So we had a huge bounce back in March. In February. That was cause of optimism. But then in March they came off a little bit, and then there is this real estate sector which is really in the doldrum. So that is something that is a little bit concerning. But let's put it this way. When it comes to China, we do expect strong, very strong growth this year, right? So the numbers that came in this morning from China were particularly good. So there is no reason for me to revise, for us at Rystad to revise our latest, the demand forecast. So let me also show you what we have, which is cool. We have this real-time indicator of traffic, so it's basically a very good proxy for demand. And what I would like to show you is that this is global road traffic across all the world. We cover the entire globe, right? So we can go as granular as São Paulo or San Francisco, and as wide as the entire world. This is the view of the entire world global traffic. This is the first time since the pandemic where global traffic stays above 100% for 4 weeks in a row. So you see, we attempted to be at above 100% a few times in the past 2 years, but this is the first time that it actually happens for a consistent number of days and weeks. And the reason for that is that China has had this very strong growth, right? So China last year was they probably
Oops. I'm sorry, Claudio, you're breaking up. Oh, Claudio, I'm afraid you've frozen up on us.
The world has been besieged by. Can you still hear me?
You're back now. We'll keep our fingers crossed.
When did you lose me? At how many seconds ago?
You were talking about China.
Okay, China. So China is back in shape, right? So that's the main takeaway. Europe is not having a big problem at all. So specifically Germany and France, their traffic indicator is very strong, right? So US is at 100%, 101%. So demand, as far as I can see from the road transportation, is in good shape. I'm a little bit more concerned about aviation. So aviation, the reason why, unfortunately, there is a problem with my connection. So let's see if we can solve it right now. Hopefully you can still see me.
Yes.
Yes. Okay, perfect. So let me go back to the slide here. Perfect. So as you can see here, domestic aviation has plateaued for the past few months, and international aviation struggles to come up. So another way to put it is that the aviation sector is still dislocated from the pandemic. So this is something that we need to bear in mind. So when it comes to OPEC, there is a suspicion that the reason why they cut was that they were also concerned a little bit on the demand, basically what the global oil demand was doing. If I look at the rate of growth in demand, specifically the past couple of quarters, you see here the last quarter last year and the first quarter this year, the numbers were not strong, right? So we have to bear that in mind. The expectation, though, is that the second quarter, third quarter, fourth quarter, those should come in with a lot of growth. But look at where the growth is supposed to come from. It's China, right? So we heavily depend on China for oil demand to grow. And I also have to say we heavily depend on one sector, which is still very dislocated, which is the aviation sector. So you can see here, this is the numbers that we had back in 2019. We are still very far from those numbers. You see 7 million barrels per day in global aviation. Last year, we averaged around 5. So the aviation sector is still far from being back to normal. So this is what is basically boiling on the demand side. Strong growth, right? So strong growth last year. We expect strong growth this year, but there are some indications that the situation might not be as strong as originally expected. So what we are seeing is some numbers specifically from the United States and Europe coming in weaker than expected. But at least this morning, we got some very good news from China, very strong first quarter. So we are digesting those numbers to see how big the demand growth in China was in the first quarter. Now, if I look at the supply side, the situation is also bullish in the sense that we are not seeing a whole lot of growth from the supply side. So if I look at the United States, we are
I'm sorry, Claudio, you're breaking up on us again.
On 19, right now we are at 12. Hello?
Yep, you're breaking up on us again, Claudio.
Okay, so let me try and join through the phone, if that is possible. Let me try to do it quickly. So hopefully the connection remains stable for the next few minutes.
Would you like us to, why don't we invite Francisco to talk, and Claudio, why don't you try to disconnect and then reconnect the other way, and we'll come back to you at this point of your presentation.
Sounds good.
Okay, thank you. We'll see you on the back side of it. Thank you.
Yes.
Francisco, I hope you don't mind if we jump over to you to
Sure.
Pick up before then.
Sure.
Thank you.
Can you see my slides?
We can. We're on your projected growth. There you go. Okay. Yes, we can.
Okay. So what I'm gonna do in the next 10 minutes is sort of focus on a zoom in on what Latin America might provide in this juncture and in the years ahead. So, sorry. So the first thing to notice, of course, is that Latin America has a very abundant resource endowment, second only to the Middle East. I mean, there are different ways to measure these, and these are not the official figures, but some estimates by WoodMac that I think are more that reflect better the situation in the region. And of course, resources are concentrated in Venezuela, but there are, and a lot of it is, extra heavy oil, and for a variety of reasons, it's unlikely to be developed. But you can see that Brazil, Guyana, and Argentina have significant opportunities for growth. Mexico, to sustain their current production, will probably need to add some numbers to these resources or reserves. So let's focus now on the current situation. So Latin America is probably going to have the best year in the last at least 2 decades in terms of growth of production. The estimate is around 600,000 barrels of additional production. You can see here different sources, our friends at Rystad and the International Energy Agency and OPEC. OPEC doesn't estimate their own members, projects their own members' production, so Venezuela is out of the picture here, but we can see that the estimates go from about 500,000 to 640 or something, depending on what measure you use, and it's concentrated on basically say 4 countries, but basically Brazil and Guyana being the main ones, and then Argentina and Venezuela, no? And if you look at the longer term, if you look at sort of the decade, estimates to 2030, you can see that again, Guyana and Brazil are the biggest additions of production that we can foresee in the next decade or so, and Argentina and Venezuela is a big question mark. So here you can see the general added production of all the region, and you can see that it has been in decline. Latin America was producing more than 11 million barrels of oil at the beginning of this century. Production actually declined during the boom times because Venezuela and Mexico's production declined, and is just recovering now with the addition of these particularly these 2 significant productions from offshore, which are Guyana and Brazil. Guyana is adding 1 floating vessel, a production vessel, this year, at the end of this year, and so that's why they have this significant addition in production after all these discoveries made by Exxon on the Starbreak block. And then you have, in the case of Brazil, around 4 to 5 additions of floating vessels, production vessels being added on. So it's important to notice that these are decisions that were made in the past. So these are not elastic to the current changes in prices. The difference between different projections has to do with sort of technical, how fast these assets are deployed and put into operation. The case of Venezuela is different. Venezuela is a story of a collapse of an oil industry that recovered a little bit last year, the last year and a half, because of the recovery of oil prices and the capacity to evade U.S. sanctions. But recently, there was a license given by the U.S. government to Chevron that has allowed for an increase in production of about 50,000 barrels so far, and it probably will add to over 100,000 barrels by the end of the year. Mexico's production has stabilized, but is likely to keep going down in the next few years because of President López Obrador's policy of closing the sector again, and the problems that the national company faces with very high debt and very limited capacity to increase production. Argentina is the other interesting case. In Argentina, as in the US, what you have is mostly shale and tight oil, and the price signals do sort of move quickly into investment decisions. Of course, the Above ground risk in Argentina are very significant. This is a country in the middle of a macroeconomic crisis that has exchange rate controls. So the decisions of investments are hard because you don't know if you're going to ever get your money out of it. But it has had some interesting developments and investments. The rest of the countries in the region are Colombia and Ecuador. The other two major producers are basically production is either stable or declining in the foreseeable future due to a combination of lack of potential in terms of resources, but also because of policy issues, particularly in Colombia. Having said that, it's interesting to look at, in oil, you produce where the oil is, right? And so as a result, Latin America, particularly Brazil and Guyana, look pretty good in terms of the combination of openness to investment and stability, political stability. And that's why these two countries are in a very good position to attract investment from private companies. And here you can see how a lot of the decline in investment in production in Russia and Central Asia is going to be lead to investment in Latin America. And so this list of companies that you see there, basically the main investors in the private sector are going to be increasing their share of production that happens in Latin America and the total production that they have in the region. That sort of compensates the problems that, except for Petrobras, national oil companies have in the region that basically they are unable to increase production. And I just wanted to look a little bit ahead to talk about two sort of issues. One is the cost issue. Latin America is sort of in the middle in the cost curve, both in operational costs but also in some of the main break-even of new projects between the high-producing countries in the world and the really low producing countries in the Middle East. And so depending on the price environment and the future of demand, Latin America has very divergent scenarios. The other issue, of course, is that Latin America is also, it varies a lot, but in the middle in terms of carbon intensity. And so depending on how demand and prices evolve, Latin America might actually play a very significant role if more production is needed in the world, because otherwise, if we sustain demands of 100 million barrels, for example, per day, oil demands, that will require significant additions of production from Latin America. But if we have a very fast energy transition, given the issues of cost and the issues of energy intensity, Latin America will suffer disproportionately, meaning that the Middle East will increase their share of production. So basically, the region has a massive potential because of the resource endowment, but above ground risks and the issues of cost and the issues of course, of world demand and energy and carbon intensity will be there. It's sort of affecting the way this industry develops in the region. So I think I will stop here and
Thank you, Francisco. Thank you, and I hope we'll have some time in the questions to ask you about some of that above ground political risk. Claudio, are you back with us?
I am. Can you hear me better right now?
Yep, and we see your slide.
Okay, perfect. So let's catch up from where I left. So the United States production is growing, but not as quickly as we expected initially. So we still, you see, we're not back yet to the level we were before the pandemic. So it means that not enough hydrocarbons, liquid hydrocarbons coming from the United States, unfortunately. If I look at the situation in Russia, Russia is the second largest oil producer in the world. second/third, depending on what the decisions are in Saudi Arabia. But you see that after the two bans from the European Union, first the crude and then the product ban, we saw a decline in Russia crude production by roughly 700,000 barrels per day. We may debate whether or not that was voluntary. My theory is that Russia was very successful at keeping the seaborne export, both of crude and products, high. As a matter of fact, all-time high for them, but they were less successful in redirecting the Druzhba pipeline, which was the major pipeline that brought crude from Siberia into Europe, from being a pipeline to being waterborne. So that was kind of less voluntary than probably they would like to admit. So United States growing, but not at 1 million barrels per day, growing at roughly 500,000 barrels per day year on year. Russia losing production. On top of that, now we have OPEC making this very surprising, as Jim said, cut just a few weeks ago. And you see, if I right now look at OPEC Plus, which includes the former Soviet Union pledges versus what they're actually producing in the month of April, you see that the gap is as large as 4 million barrels per day. So what does this mean at the end of the day for the next few months? So the topic of our webinar is OPEC Plus and summer driving season. Well, I am afraid a little bit I have to warn you that we are more likely going to see higher prices going in the next few months. And higher prices means that Brent could actually approach $100 per barrel, because if you see here, so the gap between the supply of liquid hydrocarbons and the demand is widening dramatically just as we go into the summer driving season, so June, July, August, etc. So this is our profile for demand. You see, at some point, demand should reach 104 million barrels per day, so much higher than the pre-pandemic level, while the supply remains relatively flat, and this is the result of Russia decreasing, the United States not filling the gap. Great presentation by Francisco talking about the increase in South America production, specifically Guyana, even Brazil. I would say that is not enough to close the gap that we see in the market. And we see a very similar picture, by the way, if I look at the crude supply and demand balances, which is in the bottom of the screen. Therefore, I mean, our conclusions are that we are going to see significantly higher prices from a fundamental perspective. So if I look at really the fundamental supply and demand drivers. Something, though, is in the back of my mind, which is from the demand side, we need to be aware at least of three key risks as we go into the next few months. The first is that aviation plays a huge role this year when it comes to the oil demand growth. And so far, remember the first slide, one of the first slides I showed you, the aviation traffic has flatlined. So this is the first yellow flag. The second is that we are overwhelmingly dependent on Russia growth this year, like we were before the pandemic. So that shouldn't be too much of a concern, because specifically China has been particularly strong in the first quarter. And the third, which is something that we might want to debate, is the potential for a significant slowdown in the OECD and elsewhere in the world, which would trim our demand growth quite significantly. So these are the key risks that I see. But if the risks do not play out, so if we are in the base case, then what we're going to see is that the OPEC plus cut will result in Brent approaching $100 per barrel in the summer. Let me pause there and see if there are questions.
Thank you very much, Claudio. And if I'm doing the math right off the back of my head, an extra $15 and the price of crude oil, all other things equal, would give us another roughly 30 cents a gallon at the pump. So let me turn to a few questions before I invite our in-person audience and our guests online to submit questions as well. And by the way, for people who are joining online, remember you can type questions in on the Q&A function. So I had like one kind of tactical question, and one kind of more strategic one, I guess. I mean, on the tactical side, first, the OPEC cut that we just saw, is it politics or economics? We've kind of had some back and forth already, from Jim, but Claudio, I'd welcome your thoughts as well. I mean, what do you think motivated the actions? The surprise cut a couple of weeks ago.
Look, it's very difficult. We do have conversation with many of the members on a continuous basis. My hunch is that this one in particular was probably more driven by economics, in the sense that my perception is that OPEC would like to keep prices in a range. They do not like prices that are too high because they begin to destroy demand. But to the same token, I think it's probably important for them to look at the $80 per barrel Brent, kind of their threshold. So I think that in this case, probably the economic factors were a little bit more prevalent. I fear that this could result, if demand keeps being strong, in an overshooting. So in prices potentially going a little bit too high for OPEC to be comfortable with. But I think overall it was probably more economic this time.
Jim, anything you'd like to add, in addition to your earlier comments?
Well, I mean, I think I think lots of different planets have to line up, I think, for them to take this action. Domestic, spending projects in Saudi Arabia and the difficulty, raising capital for that, through foreign direct investment. I mean, really, they're just not getting any foreign direct investment. So I think there's a lot of suspicion out there that these giga projects aren't, something that you like to plow your cash into, that there may not be returns from them or much. So, I think the Saudi demands for, just to raise funds for its domestic needs is I mean, I guess to the extent that's an economic situation, that's probably part of it. Mm-hmm. But yeah, I mean, I think there's probably lots of factors that weigh into this. I think we're probably touching on some of them. I mean, I think you and I have talked about this sort of obsession, if you will, among some of the OPEC players with the speculators. The new minister, Prince Abdulaziz, likes to, surprise the market. So right. So there's there's lots of different, I think factors that went into it. But I think that Russia, is. Faltering. As Claudio said, some of these cuts that it's making, are they voluntary? Are they involuntary? But that, I think, kind of, it was sort of working in their favor as well. So I think the planets kind of lined up.
Yeah, and I would note with interest that Russia had previously announced its intention to cut production by 500,000 barrels a day, and the Saudi surprise announcement, literally matched that to the barrel of 500,000 barrels a day. One of the big fundamental precepts of this OPEC Plus organization over the years has been parity, between Russia and Saudi Arabia in terms of their production targets. Interestingly, I would note that the OPEC Secretariat, among the major publicly available forecasters out there, the OPEC Secretariat actually has by far the strongest projection of growth in global oil demand this year. So at least based on the official OPEC Secretariat view, at least from the demand side, it doesn't look like an especially weak set of information that the decision makers are working off of. Claudio, were you trying to add in?
No, I was, Mark, I just wanted a question for all of you, including you, Mark, is let's assume that the Saudis because they, you know, if you went to CERAWeek a month ago, everybody was thinking that, you know, the first half of the year there was some surplus supply, and then markets will tighten the second half. And let's say that the Saudis acted, as Claudio said, a little bit of an analysis, but if he's right, and I think he probably is, then, you know, the prices might overshoot. So what will the Saudis and OPEC do in the second semester of this year in that scenario? I think it's interesting.
Yeah, absolutely. And I would, in fact, I noted on Claudio, one of your final balance slide did show a big jump in crude oil and liquids production in January of 24, which I was going to ask you, but I presume is an assumption of a reversal of some of these OPEC cuts. Yeah.
Correct.
Yeah.
That's correct. So we assume that the cut will last until the end of the year, but again, as Francisco was pointing out, if the price overshoot, which is definitely a distinct possibility, then it's very possible that we're going to see them reversing them much earlier. Right. So it's if we look at the fundamentals right now, we see a tremendous gap between supply and demand. We're talking about expected inventory growth of between 2 and 3 million barrels per day for the next several months, starting in June. So this is a situation which arguably warrants for a significant, very, very strong backwardation, which means, again, prices approaching $100 per barrel. The only caveat there is that if you look at the global crude inventories, you may argue that Brent is more affected by OECD liquids inventory than global crude inventories, but there is a little bit of a shift in the price formation lately. So global crude inventories are playing a more and more important roles. If you look at the global crude inventory, as a result, by the way, of the SPR release, as Jim pointed out, they are at a very, very high level right now, probably one of the highest levels in the past 5 years. Therefore, that is also something to be considered. So as usual, when we talk about the oil price and the oil markets, there are many, many factors at play. But my tenet is that eventually the supply and demand fundamentals prevail, right? So they also prevail on speculation and anything else. They are the fundamental signal. Right. So at this point, OPEC has made a tremendous cut, and we are in a tightening market.
Let me ask a bit of a different question. There's so much focus on the rapid growth of EVs, at least in terms of sales, and I'm just wondering. I mean, we could come at this from a lot of different directions, both in terms of, for Claudio, what impact are you seeing already on global oil demand from the rapid growth of EV sales? But I'd also be interested in whether, Francisco, I mean, clearly some of the big suppliers of the base metals that go into the batteries coming out of Latin America, and between you and Jim, how might the rapid growth of EVs and the rapid growth of their mineral requirements shift some of our conversation about the geopolitics of energy? Let me start with you, sure. Claudio, in terms of what you're seeing in terms of actual demand, oil demand impacts from EVs.
Absolutely. So I used to say for many years, right? So even in my times, I remember many years ago when I started working on the energy transition, almost 10 years ago when I was at Shell, I was saying that the energy transition will happen, but don't worry right now, because you're not going to see it in the numbers. And this year, I remember at IE Week, so I was in London about a month and a half ago, and it was the first time I said, well, that statement is no longer valid. Right now, you see the energy transition, the number, at least in one sector, still very tiny numbers, of course, but you see it, and it is in the passenger road transport. So let's not forget, passenger transport is 20 to 25% of oil demand. So we're talking about 27, 28 million barrels per day. And right now, last year, the global share of EV, this includes, by the way, plug-in hybrid, of the total new sales of vehicle was 16%. So 16% means that we sold something like 12 to 30 million electric vehicles. So they're no longer insignificant. We have right now a global EV fleet of roughly 40 million vehicles out of 1.2 billion vehicles. So long story short, what is the impact on oil demand? it is about 500,000 barrels per day. So as of 2022, and this year it could grow to, depends on what the numbers would be, 600 to 700. You may argue, well, is this material? Yes, it is, because the oil markets are based on marginal economics. Therefore, any barrels count, right? So even 50,000 barrels count. So let alone 500,000 barrels. But in the grand scheme of things, 500,000 barrels is 0.5% of oil demand. But the point is that this will continue to grow as we continue to deploy more and more electric vehicles. Now, we can go into another webinar, which can last 2 hours, Jim and Mark, talking about how will the electric vehicle be deployed in the next 5 years, 10 years. And I mean, frankly, any assumption is good at this point. They can stop growing because we don't have charging infrastructure. They can continue to and eventually dominate the total sales of vehicles because all the OEM are investing and the consumer like it. My piece of evidence is that when I go to Europe, in Norway, where basically in Rystad is based, the general headquarters, many electric vehicles. Even in Germany and even in China. When I go to South America, Middle East, I don't see any of them. Right. So we need to take this with a grain of salt. So it's likely that probably we're not going to see a continuous growth at the pace that we saw for the past 5 years.
Interesting, thank you. Francisco and then Jim, if you want to just weigh in on the geopolitical ramifications, but I'm going to ask you to just be very concise because I want to make sure I leave time for a couple of questions here. Francisco?
Sure. So as you point out, that's going to be a big challenge. If we extrapolate the issues above ground risk that Latin America has faced in oil and gas, and you see that demand growth for minerals, critical minerals like lithium and copper, you already can see some resource nationalism arising in Chile and Bolivia, in Peru. And President López Obrador in Mexico sort of nationalized the lithium sector. So I think that will potentially pose a challenge for the rapid development of these mining resources. And of course, there might be some substitution with other minerals and other options, but I think it represents a big hurdle for the development of the sector.
Well, I might talk a little on the sort of the thinking about the political side of it. Here in the U.S., I think as something that we may see, right? So as more U.S. voters move into electric vehicles, right? We might not see a big effect on overall oil demand, but I suspect it might give the U.S. president a bit more leeway, right? We know that about this negative correlation between presidential popularity and the gasoline price, right? So, but as we have more voters actually less exposed to oil prices like that, less directly exposed to it, right? They're driving EVs. They don't really care about the gasoline price so much anymore. U.S. president is going to have a bit more foreign policy freedom of action. May see. A bit more willingness to take on, Saudi Arabia and other oil-producing countries. Might see even the Carter Doctrine, that we're going to, go to war to protect our interests in, the Persian Gulf. That could weaken a bit. So this trend of separation between U.S. and Saudi Arabia, that could be exacerbated and not even affecting oil demand that much, right? We'd still have, fairly high oil demand in the, in the other sectors. Just with U.S. voters stepping away from direct exposure might be an effect.
Thanks. So we have time for some questions from our audience. Can I ask you though, please, to be very concise in the way you pose your questions? And there are mics in the room, so you don't need to worry about it. Just project, sir.
I wanted to ask about the U.S. Strategic Petroleum Reserve and the Strategic Petroleum Reserve of the other major industrialized countries, how that's going to affect the market. The Biden administration did not proceed with a refill strategy. Some commentators suggested that influenced the decision of the Saudis to cut. What do you guys think?
I'm going to hand it over to you, Mark.
You don't need to hear me talk. I'm just the host. Claudio, do you have a view on the role of the SPR, both in the U.S. and around the world, in terms of the gentleman's question?
Yeah, absolutely. So if I look at the total SPR in the world right now, and I'm talking about crude SPR, they are at a very low level, one of the lowest, but we're still talking about 1.5 billion barrels, right? So the United States is roughly 330. The question is, should the United States refill its SPR at 600? Probably not, right? So probably 600 may be high because the United States is no longer a net oil importer, it's a net oil exporter. But globally, we need to bring back the SPR at some middle of the range level. I think that right now, releasing further SPR in the United States would be bringing the U.S. in a danger zone, because then they will be too low, even considering the United States no longer imports huge amount of oil. But to the same token, there is no impending need, a very urgent need to refill them this year. So the U.S. administration can wait for prices to be lower, for instance, and doing it later. I know that, of course, this was a contention between Saudi Arabia and the United States. That may be one of the reasons why there was this OPEC cut. But if I look at globally, the global SPR, they are at a low level, but not yet in the danger zone.
Thank you, sir.
Yes. Fortunately, Europe had a mild winter and Norway had plenty of gas. Russia will sell anything to anybody for any price. KSA continues to do development drilling and increasing their capacity. As you pointed out, Jim, they need lots of dollars. They own lots of dollars. They want to keep those elevated. Now that we've seen with 2 or 3%, 2 or 3 million barrels a day, you can manage prices. Could they essentially be the only gorilla without their Gulf area OPEC partners? Thanks.
So you mean sort of going rogue within OPEC or out of OPEC and not listening to the others?
Run things.
Yeah, I mean, I took a look at that. I mean, I think they could probably, they and Russia and maybe a couple other big Gulf producers, they don't really need the smaller members. And I think that's become more apparent within OPEC Plus, right? I mean, these decisions to cut, right, are being taken out, not even, they were being taken in this, JMMC, this sort of marketing committee. And now they're not even going to that to make some of these decisions. So I think what you're talking about is it's already happening to an extent. And you're starting to see some chafing among other OPEC members, especially the UAE, right, which is investing in, it's trying to build up from 3 to 5 million barrels a day. And as it invests in more production, it's shouldering a disproportionate share of the cuts. So I think what you're talking about is already happening, and we'll see what how that affects OPEC writ large, right? If we see a few more departures.
Got time for one more in the room, and then I'm going to summarize with one question from some of the things on the website. So just a brief question, please, sir.
Yes. With these price scenarios, do you see a return of investment capital into the domestic oil and gas industry, which has been lacking the last year? And you even saw Texas passing some laws which would punish companies that were advocating a reduction of spending, you know what I mean, for oil and gas, etc. What changes do you see with these price scenarios?
Yeah, and my sense is that by far the biggest driver of the investors' demand for financial restraint is a decade of poor performance, rather than ESG concerns. But I mean, Claudio, you follow that issue perhaps within Rystad. Do you have a thought on that question?
It's a very interesting one. It's difficult to have a definitive answer. I do agree with what you just said, Mark, that the driving force for capital leaving the oil and gas industry was a very poor performance between 2016 and 2022. So does 1 year of strong oil prices make a difference? Probably, I would say we need a little bit more than that. But what we have seen, at least last year, was a significant uptick in Permian production. Mm-hmm. So that is something that we have seen. And this year, we also forecast growth of something like 600,000 barrels, which means that money is coming back. What I think we will not see anymore is the growth of the 2010s.
Okay.
So this was just focus on top line. Right from this point onwards, we will continue to focus on the bottom line.
Okay, thank you. And now, I'm summarizing a few bits on the web that have come in. You know, I set this whole thing up by talking about prices at the pump, and I'm conscious of the fact that we haven't talked about prices at the pump at all. Of course, in most occasions, the answer is, if you want to know what's happening with prices at the pump, look at what's happening with the price of crude oil. Over time, over long time periods, the correlation is almost perfect. 2023 was not perfect. You know, we saw unusually big jumps in refining margins for gasoline, but especially for diesel fuel. And Claudio, let me end with asking you, what are Rystad's views on refining margins? You know, are they going to remain elevated or kind of return to kind of more normal relationships?
Yeah. So another great question. I think that what we saw last year was really unusual. It was the combination of, it was the perfect storm for refining. So demand growing at 3 million barrels per day last year, 6 million barrels per day the previous year. And of course, refining capacity being closed at the same time, because it takes a little bit of time. There is a lag between the moment you decide to close a refinery and the moment you actually close it down. So last year was a perfect storm with refining utilization through the roof, which means that eventually even the least efficient refinery being put on the market, which elevates the price for everybody. Gasoline cracks through the roof, gasoline crack also very strong. This year we are going to see a normalization of that, right? So we're probably going to see margins, if not back to the long-term average, definitely trending towards the long-term average. Okay. So that component of the gasoline price will actually behave in the consumer favor. The crude component, though, it probably is gonna go against the consumer.
So potentially some good news as well as some warning signs for consumers at the pump this summer. So, so let me just wrap up briefly. First, thanks to all of you for taking time out of your busy schedule to join us and for the great questions, both the online and the in-person audience. You know, we said, what does the OPEC Plus surprise mean for prices at the pump? You know, we explored questions about, is it economics? Is it politics? As always in our industry, the answer is yes. One of the things that's made this so much fun for so many years for me is that it's an all of the above kind of you know, life here. You know, and you know, and it's not just a pointy-headed academic pursuit. It's something that matters in the street, matters to all of us, matters in our households, matters in how we think about the future, matters in how we spend money, how we invest money, how we vote, what it means for the sustainability of our energy system, and so we didn't give you a prediction for prices at the pump. We gave you some red flags. We gave you some potential good news indicators, but hopefully we gave you a lot to think about and chew on. Please join me in thanking our expert panels, Jim, Claudio, and Francisco. Thank you all, and have a good morning.
All right.